Lowe's and Home Depot both reported really strong numbers. We're going to take a look at Lowe's right here. This is a company for me that is kind of a leading indicator. When I start seeing Lowe's and Home Depot, those types of stores start to decline, that's when I'm going to get a little bit scared. Not only because it's the DIY person who's doing their own projects at home, maybe doing projects that they don't need, but that's going to tell me a lot about the construction world. You have a lot of contractors that go there, and as soon as they start going there a little bit less, you start to see their numbers trickle down. That is when I'm going to start to worry a little bit because it's the more mom and pop that are spending less money. But based on second quarter, people were not spending less. Total sales came in at $27.5 billion versus $27.6 in the same quarter in 2021. There was a little bit of a decrease, but to me, that is not that bad. And this number, I've talked about it in multiple videos and multiple times on the morning show. 27.6 is a very, very big number, and that was in 2021 when we were coming out of the pandemic. People were still spending like crazy. They had a lot of pent-up money. They were doing projects that they never did before, and they have always meant to do. Unnecessary projects, I should say, that kind of were a luxury. I thought that this number would be a little bit lower because you kind of removed that, but people still came. People still did their projects. We didn't see that decline like we saw at the Walmarts and the Targets of the world, which is really good. Comparable sales for the U.S. home improvement business increased 0.2% from the second quarter. For the second quarter, DIY sales were impacted by a shortened spring and lower demand in certain discretionary categories, which were partially offset by a 13% increase in pro customer sales. So I didn't know this, but a vast majority of shoppers at Lowe's are your DIY people, just like you and me going to do a project, although you probably don't want to see me do a project because I'm not very good at it. But you did have people paying the pros to go and do things, so we did get that offset. CEO said, our results in the first half were disproportionately impacted by our 75% DIY customer mix, which was partially offset by our double-digit pro growth for the 9th consecutive quarter. The company repurchased shares. This is what I don't necessarily like because I have to guess that this is a rather expensive company because their trajectory has basically been this since before COVID. They were a great company before COVID, and I think that they're probably a little expensive, but we'll look at that when we go to Stock Analyzer tool. They purchased $4 billion worth of shares. I'm not a big fan of companies taking their money and buying back expensive shares. I would rather see them invest in themselves, maybe pay out a little bit of a dividend, but I do not want to see them buying back their shares at expensive prices. That could change situation to situation, but based on this situation, I don't like to see it. Total sales for the full year outlook going forward, 97 to 99 billion. Gross margin, they are expecting that to be slightly up compared to the year prior. And their ROIC, which I like to highlight, over 36%, which is absolutely incredible. Let's come over here just a little bit more about their earnings call. Transaction volume was down 6% over the quarter, but this is probably due to a lot of inflation issues, but average ticket prices were up 6.5%. So they have compensated a little bit based on inflation. I'm assuming that ticket number was down because of the inflation that we're facing right now. Things are a little more expensive, but the ticket prices were up so that they are kind of compensating, playing that balance game where they can actually not get smashed on gross margins and profits, etc. So let's see here. PE ratio is a little bit rich. And guys, I'm going to quickly just run over the 8 pillars. Market cap of $142 billion. Their dividends paid are very comfortable. I did a video prior to this one on Target, and I wasn't totally convinced that their dividend was 100% reliable. It wasn't the worst thing in the world, but $2 billion out of nearly $7 billion, average of about 5.75 over 5 years. They can comfortably afford that dividend to their shareholders. Their ROIC is a very big number expected, as we saw. Return on invested capital, the 5-year return on invested capital right now is 21.1%, and they are at 25% now. They expect that to be over that 37% number. So let's pull up the income statement and just take a quick look. I'm expecting to see explosions in revenue and profit due to COVID, and we are certainly seeing that. $50 billion in 2013. 2018, you were at $69 billion, and now you are nearly at $100 billion, or at $95.5 billion. And you saw the big move. Pretty consistent growth, and then an explosion from 74 to 94 billion. It's an anomaly. As an investor, I can't rely on that number to stay there consistently over the next couple of years. Profit, same thing. Consistent profit, consistent growth, consistent growth, consistent growth. And then you had these almost double, big jump again. Net income, I cannot rely and say this is going to happen forever. Could it happen forever? Absolutely. Let's see what they've been doing with shares. So they've been, this is the one thing that I do like. The company has been, it's not like they just started buying back shares in 2021, 2022. They have been consistently buying back shares every single year since 2013, maybe beyond 2013. But that's something that I really like to see, is that it wasn't just some situation that came out of nowhere and they decided to buy back shares. Total current assets of $25.6 billion. Total current liabilities of $21.8 billion. Let's see where, remember, we have to look at their real estate. Capital leases, $760 million. Let's see here. Total long-term liabilities, 56. Total $56 billion. Okay. Let's go and look at their cash real quick. This cash flow number has just exploded. Absolutely exploded. Nearly doubled in 20. And you got the same, I mean, that's their net income. It's just absolutely exploded. Let's look at their cash situation. Wow. Wow, wow, wow. Free cash flow, $6.86 billion. All right. Let's look at, let's go to the stock analyzer tool. And before I do stock analyzer tool, I wanted to introduce myself. My name is Mo. Paul and I are value investors. This is how we look at companies. We look at different metrics and we pull them together. So we're not just looking at the stock. I haven't even looked at the stock price. It's funny. This stock price has gone up 16% in the last month. I hadn't looked until right now to say that this is $214.72. I don't just look at a stock price and say, hey, that looks expensive, that looks cheap, it's going to go up or down from here. I have to go through, understand the company's financials, understand the real workings from the company, and understand what's going to happen in the future. Are they going to sustain this? And if they don't sustain this, what do I have to pay? What do I have to analyze today in my model to pay an appropriate price and get an appropriate return over a long period of time? So let's do that with Stock Analyzer tool. Revenue growth. So I'm going to go conservative on the low end. I'm going to put 2 because I don't know how much they can really grow more. I'll put in 2, 5, and 8. I'm going to say that, let's say they do 8% revenue growth over the next 10 years. Profit margin. Let's go with 5.5. You know what? Let's go with 4.5. No, let's go with 5.0, 5.5, and 6. I think that's a little bit better right there. Free cash flow, I am going to go a little bit higher. I'm going to go 6, 6.5, and 7. Nope, I'm going to go 5.5. I'm thinking about this on the fly. I'm adjusting this to say, are these numbers realistic that I'm putting in? Because I thought that the 7 number, it was going to be a little bit too high. I'm going to go 13, 15. You know what? I'll go 14, 16, and 18 here. I think that if you're going to go shopping at a hardware store, it's going to be one of these 2 stores. And that, for some reason, tells me that I can give them a little bit higher PE, even though I don't think they have the growth. Desired annual return, I'm going to go with 12.5% because the average return on the S&P is over 100 years is 9.9%. If I'm going to take all the effort to go through here and analyze this and look at the financials and understand the company, I need to get more than 9.9%. So therefore, I'm going to put in a margin of safety of 12.5%. Let's see what this spits out. The company's just expensive today. It is expensive today. Somewhere in the range of $81 to $188. Today we're sitting at $215. I think my range is probably somewhere in that $140 range. That's probably where I would start to look to sell puts. Now, maybe I go and start selling puts at this thing in February of next year. Something like that. See if I can get some type of premium. But for right now, this company is just a little bit too expensive. For you traders, if you stuck around this long, let's look at Lowe's, because this is a very interesting company that is just ripping. LOW, here we go. They are, and I'm going to zoom out here because I want to show you one specific thing. We are running right into this 200-day moving average. And you notice we've had good volume for the last couple of days, increasing volume for the last couple of days, good earnings, and look at all these wicks. It cannot break through that 200-day moving average, even with good volume. And you can see today, it is 211 right now, very weak volume. So this thing could be running into the 200 and just fall right back down. This 200-day moving average is where a lot of hedge funds, it's where a lot of quant funds make the decision to go and buy the stock, sell the stock, doesn't let it get through that number. You're just losing volume, and that's exactly what you're seeing here. I showed you the 8 pillars before. If you want a deeper dive into the 8 pillars, click this video right here. Paul will go through it with you. I'll catch you on the flippity flop.